Welcome to Ticker Talk. I'm Ted Ohashi, coming to you today from the offices of InvestmentPitch in Vancouver, British Columbia. I'm pleased to have with me today Richard Carleton, CEO of the Canadian National Stock Exchange, the CNSX. Richard was in town recently to discuss on a panel the problems with the venture capital market and what can be done about it. In my view, and his too, I'm sure, the CNSX is potentially part of the solution to that problem. So if he answers some of the questions that way, I don't expect him to be apologetic about it. Richard, thanks for being with us.
Thanks, Ted, for having me. It's always a pleasure to come to Vancouver.
Great. Tell us a little bit about the CNSX.
CNSX was founded about 10 years ago by a group of folks with deep experience in the stock market business in Canada. And the notion was that we could create a better model for entrepreneurs looking to raise money to fund their startup business operations. So by definition, we were firmly targeting the early stage capital market in Canada with the range of services that we offer.
And tell us a little bit about your background.
Well, I had a long background in the industry with the other stock exchange group in Canada. Left much earlier this century as a member of the exchange's senior management team with a particular interest in market information, new market services, and the public relations group.
One of the big things that came up during this panel discussion, and I think right away sort of distinguished the CNSX from the other exchanges, is bank ownership. And some of the problems that people perceive are created for the venture capital markets by the banks. What do you have to say about that?
Well, I think there's a lot of discussion in the industry. Is where we find ourselves right now a result of a bear market in the underlying commodities that many of the early stage capital companies in Canada are looking for? Or are the issues broader than that? And I think it's fair to say we're certainly in the camp that the issues are broader than that. That what we are seeing is a fundamental change in the securities industry in Canada, where there is more and more influence in the industry from the bank-owned dealers. And you're not seeing the independent dealers, the groups of advisors and so on, who traditionally have been an important source of capital raising. They're fewer in number, and the prospects, given the amount of regulation and the expense of operating those kinds of businesses in this day and age, mean that I hope I'm not right, but it's possible that it's a dying breed. And so if that's the case, if we're going to get out of this rut that we're in currently, we're going to have to support new models, but we're also going to have to encourage, where we can, the traditional means of working with the dealers, the advisors, and the issuers to get those stories told to the investors who are putting up the money.
But at the end of the day, why does it matter? I mean, does venture capital, does risk capital matter to the Canadian economy?
Well, that's an easy question, Ted. We were laughing about it before, but it is absolutely critical to the Canadian economy. It is a trite observation, but it's absolutely true that small business creates the bulk of jobs in the economy. It is a tremendous engine of growth. And if you look at the S&P TSX 60 index, for example, a number of those companies started as 10 or $15 million startups. And those are the kinds of stories that we need to support. And quite frankly, Ted, it's something that the Canadian marketplace does better than anybody else in the world. I mean, we are the envy of the United States, who have basically destroyed the early stage capital market. And we are constantly being visited and spoken to by people from Australia, or European Union, the UK, to try and create in their own economies this sort of thing. As I say, it's a tremendously powerful and important segment of the securities industry in Canada, and we really have to fight to make it succeed.
I thought it was quite interesting that the audience was made up to a great degree by individual investors, people who were coming to the conference. And they were complaining about the regulations. Do you think the regulatory model has gone too far?
Well, there's certainly an abundance of focus on so-called investor protection. And the principles and the practical elements of the new regime that are being put in place certainly put tremendous additional costs on the operations of the dealers. And of course, the bank dealers with their much larger scale are more easily able to absorb those costs and to implement those procedures. They have the compliance people in order to do all of that. Plus, the other big concern, and I think why a lot of the people there yesterday were upset or had their own issues, is the whole, the client relationship model, know your client, and so on. They're really pigeonholing people into very blunt models without an awful lot of flexibility. So an older person who still has an interest, for example, in speculative stocks, high risk, but somebody who's prepared to accept those risks and so on, is going to find that they're going to have a hard time with a full service broker, having that broker handle those orders for them. It's going to be very difficult.
Right. As somebody observed from the audience, brokers now are being expected to know the securities as well as they know their clients. And, with so many securities out there, how can anybody possibly do that?
That's absolutely right. And as I say, it certainly doesn't bode well in that model for junior capital, which of course comprises the large majority of public companies in Canada.
Another observation that was made quite regularly, and this plays into the CNSX model, but it's the cost for a company to stay listed and trading for a year. John Kaiser, who's a well-known newsletter writer, was there, and his list now has 720 companies that he estimates don't have enough cash to stay listed for another 12 months. So what role does the CNSX have in that?
Well, this was one of the things that we thought about when setting up CNSX, because we knew that we had the opportunity to reduce the costs of staying listed. But it's not a case of competing on price by any stretch of the imagination. Where the real savings come for the issuers is both on the initial listings process, because we have a streamlined regulation model that, while it requires a high continuous disclosure obligation, but we don't redo a lot of the work that the securities commissions, the underwriters, the board of directors have done prior to that application coming in. We don't second guess company management on their business acumen. And as a result, what people find is that the listings process is much faster. And of course, that translates into significantly lower legal fees and other advisory fees that come in. There's also a lot less risk associated with, is this company going to make it or not? Then, when the company is listed, and of course most of them will contemplate at some point follow-on transactions, whether they're mergers and acquisitions and subsequent raises of capital, we don't extract fees for those changes. And similarly, the review process is substantially lower than it is on the other exchanges in Canada. Really, what we demand is complete disclosure. But for the operator of a market, we have kind of a unique philosophy. We let the market decide the merits of the business decision that management are taking.
Right. In other words, you don't get involved in so much in approving a transaction, which sometimes can delay the transaction 3 months, 6 months.
That's right. Now, as I say, it's not a case that we're offering lower regulation or somehow that this is a loophole for people to take advantage of. Quite the opposite, because we demand complete disclosure of that transaction. But as I say, we let the people, the wisdom of the market determine whether or not this is an appropriate transaction or not.
One of the other issues that was raised quite regularly at the panel discussion was that Some of the regulations put in by IROC and the securities commissions and so forth are really designed to protect the brokerage firm from being sued. I mean, it's a cover your back kind of regulation, and that doesn't work very well for venture capital type companies.
Well, that's right. I mean, I have a good deal of sympathy for my colleagues that work at the commissions at IROC because it's not an easy job. It's easy for a broker to keep track. At the end of the day, if they go home with more money than they started with, well, then it was a good day. And if they didn't, well, you have to work harder tomorrow, sort of thing. It's a lot harder to keep score when you're working as a securities regulator. But that said, we have to understand that there are dramatically different segments of the industry, some of which can stand or bear up to particular types of regulation, and others which, in fact, may not. So I'll give you a perfect example that I talked about yesterday. The securities regulators in Canada are proposing changes to the early warning mechanism. They want to conform to the principles of shareholder activism that are in place in the United States and the United Kingdom. So they want to reduce the early warning threshold from 10% to 5% when the acquirer has to issue a press release stating the intention of their investment and where they intend to go from there. Well, on the face of it, you'd say, well, that's probably not a bad idea based on the experience with the recent TELUS issues and the Canadian Pacific Railway proxy battle. But when you then take it down from these multi-billion-dollar corporations to this much smaller companies where you have institutional investors all the time who are taking up to, say, 9.8, 9.9%, their intent is passive only. Right? They're not looking to take an activist role with, on the board or with management and so on. But by reducing that threshold, you're going to basically require these institutions to, they will sell the 5% of the stake to take them down below the 5% threshold.
They'll sell half their stake to get down to the threshold.
That's right. And yeah. I think we can all agree that the last thing this industry needs right now is more forced selling in the early stage capital community. That would be, as I say, an unwelcome development, to put it mildly. So, as I say, the regulators, well-intentioned. On the face of it, you'd say, okay, that seems to make sense. We should be lined up with our major trading partners from a securities regulatory perspective. But it's an uneven result when you compare what happens to the small guys versus these 60 index companies.
Well, that's great, Richard. Thank you for being with us today. Why don't I give you a chance to just wrap up and tell us the role that you think the CNSX can play in solving this problem?
Well, I think that difficult times like these, in fact, highlight the need to support and use the services of CNSX. We were specifically designed to reduce the cost of capital for junior companies by virtue of our streamlined regulation model, the lower costs, and then we're doing a number of things designed to enhance the secondary market trading. So, for example, we're working with a group of market makers to open up the system so that we have minimum guaranteed fills for eligible retail orders, automated execution of odd lot trades, and a continuous two-sided market with reasonable size and reasonable spreads. We're also working on the access component. That's one of the issues that investors have had over the years in accessing CNSX. All of the independent discount brokers in Canada now support full quotes and trading access to CNSX, and we expect to see the bank discount brokers increasingly provide access to their clients for CNSX shortly. We've also made real-time data available on the Google Finance portal, and that's something which is unique amongst the stock exchanges in Canada. And last but not least, we will shortly be releasing a new web facility which will give our issuers an opportunity to tell their story to the dealer and investor community, and we'll also streamline the regulation process by permitting them to upload documents to CDAR, which will automatically populate all of the other places that that disclosure has to get to. So in a nutshell, as I say, we're trying to work with these companies to reduce their cost of capital by providing the visibility and the access and the low cost of operation that really is the role of the stock exchange.
Richard, thanks again for being with us today and telling us that about CNSX. From the offices of Investment Pitch in Vancouver, British Columbia, I'm Ted Ohashi.